Hello, accounts people. Let's have a look at some irrecoverable and doubtful debts. So, a bit of theory first, a bit of underpinning knowledge. Receivables, they're a key asset in a business. They're the main source of future cash for most businesses. The amount of receivables must be fair representation in our financial statements. That's easiest to explain. What wouldn't be fair representation in this case? It wouldn't be fair representation to show debts that we're never going to receive as a receivable because it's not going to happen because they're bankrupt or in liquidation. It may even be fraudulent to do so, particularly if we use it to gain finance or to sell on as a debt, and we would be unethically misrepresenting our profits if we haven't written off bad debts or made our appropriate adjustments. On a more practical point of view, writing off the debts that we're never going to receive, it reduces your tax liabilities, income or corporation tax, depending whether you're sole trader or partnership or a limited company. And assuming it follows the rules that you'll learn in the indirect tax unit, the debt must be 6 months old and you have to formally write it off in your accounts. You can claim the VAT back. And of course, the other rule, you must have already paid it over to HMRC. It then simplifies the sales ledger because we're closing and writing off lots of minor little accounts, hopefully, that are never going to pay us. And it will save time and effort chasing debts. We're not going to make phone calls, emails, and letters to nowhere to no one because the office block or shop is empty. So our starting point will be writing off all the debts that are certain to be irrecoverable. That follows the language that's used elsewhere, so it's fairly consistent. And then our likely debts will create a general provision or allowance. The exact percentage is a bit of judgment, but it's fairly standard within industries. Some industries are worse than others. And then as time goes on from year to year, we can adjust the provision upwards and downwards in proportion to the receivables. The percentage will stay the same, but each year it goes up or down as our receivables goes up and down. And then after that, we'll have a look at a specific provision. So these are debts that are probably not receivable, also ones that aren't old enough to write off formally. And then we'll also adjust for any income from debts that we've previously written off in a few years ago, and then suddenly we get 3 or 4% 4 years later. And then we'll combine the two profit and loss accounts, the allowance for doubtful debts adjustment and the irrecoverable debts expense or irrecoverable debts account, because both items go into statement of profit and loss, so it's quite commonplace to just put the single figure in there. And then we'll have a look at the effect of the adjustments and writing off the debts and all the changes in presentation of the value of receivables in our financial position. So on to some work. So a little bit of revision really, because this should be from level 2 bookkeeping controls. This of course will be the net, and that'll be £300 off to the profit and loss account, and that means there's a debit entry in the VAT account. £60, and then that reduces the amount that we have to pay HMRC. Wish it was still called bad debts, quicker to type. And that shows that in our control account, what was a total of 26,500 owed by our customers is now, if we balance it off, 26,140. So that's a simple writing off of a bad debt. This is the newer stuff. This is creating the allowance that our rules say we can. We will have policies on this. Once we've set it at 3%, there's no reason to change it. Some companies have more complicated rules in real life as well. Older debts are a higher percent than newer debts. But this company hasn't got any allowance for doubtful debts. There's no brought down amount in there. So we're going to have to create one. And because we're doing several years, we're putting the years now, and that means our carried down amount, we need to calculate it. What it will be, our control account times 3%. So we're going to create an allowance from scratch of 1935. In fact, it's not a carried down because that's where the double entry will go, and it will go in here then. So we created our adjustment of 1935. So what that will show in the statement of financial position, $62565 in our statement of financial position for receivables. So what then happened at the end of the year? That will then get closed off because it just goes off to the statement of profit and loss, and one credit entry, so it'll be a debit statement of profit and loss 1935 as an expense, and this will be carried down this time, and therefore not sure why it didn't. I've lost my totals. Start of next year, brought down, and that's a financial position or balance sheet item. So we created it from scratch, so it's the whole amount goes into the adjustment and then the profit and loss account. But if we look at our sales ledger control account at the end of X2 the following year, it's gone up. We've got more customers owing us more money. Either bad credit control or more customers. Either way, the provision's not enough. 1935 is not enough. We need to increase it. So now, at the end of X2, I need a carried down amount that is $2,685, and that means I need to make another adjustment. I need to increase it. And it will be, say the maths, 2685 minus 1935, 750 rather, and there we are, there's our adjustment, and then at the start of X3 my brought down will now be my 2685, my increased amount, and then that means my statement of financial position will be, I've forgotten what it was number wise, minus 2685 for receivables. So that's the statement of financial position, but we better finish off our adjustment. That one, so this is just the adjustment, just the 750, and at the end of the year, to the statement and profit and loss of 750, it'll just get closed off. Just the adjustment in the statement and profit and loss. Again, it's another expense because we've increased our provision. So we better see what happens the other way around. Well, conveniently, at the end of X3, our receivables has dropped to 78,000. So looking at our allowance for doubtful debts, we've got a brought down that's higher than that, but we can still work it the same way to some extent. And I'll put that in the wrong place because I pressed the wrong button. We need to carry it down and we need our balance to be 2340. So we still need to balance it off. Now that means the adjustment, instead of being on the credit side in the allowance for doubtful debts, is now going to be the other side. And it will be 2685 minus 2340, 345. And then start of x4 will be the reduced amount, 2340. So in our financial position, it will the amount of receivables will now show as 75660. So one debit entry, and that means our adjustment this time will be on the credit side. 345, and our transfer which means this time we're now crediting the statement of profit and loss, so it will go in as income. Of 345. So before we move on then, let's have a look at how that works out. So if we call up a fairly standard set of accounts I've used for other videos, this is our profit and loss account. Revenue minus our cost of sales gives us our gross profit. Now what we're most interested here, this company has increased its provision by £48, and that's an expense as an increase. Had it been a credit entry, it would be in the sundry income section along with discounts received and gain on profit or disposal, and it will be added to our gross profit before we take off our expenses. You can see there's also £2,800 of expense reducing our profits, the same as the £48 did. In our statement of financial position, you probably, in most exams, will only see this figure, particularly in the financial accounts prep exam, but actually what it is, it's the sales ledger control account. In this case, it was 17,400 minus the allowance. The total allowance is 348 because there was an allowance of 300 and it got increased by 48 in this example. You can see this one in other extended trial balance questions that I've done, and it was originally a BPP question. So that's what it looks like in our final account. So let's have a look at the last area, though a bit of revision first. So we're going to have a look at how to deal with the specific and just build it into a slightly longer question. So first thing we're going to do is write off a bad debt. There's no VAT in this question. Ignore VAT, it'll say. So number one. So our bad debt, we're writing off 100. There's our £1,000 being written off. And it's interesting to put that one in because that's the expense, and now we've received £100. So this will be a debt several years old. We can't go back and change our accounts from 3 or 4 or even more years ago, or even 2 years ago. So we've just got to set it off against this year's bad debts. It's income, and if we receive it, it will be debit the bank. We need a credit entry, and it's going into here, in which case forget about the expense bit. It's now an irrecoverable debts account. It can of course therefore be a credit. You could have received more than you've written off in a particular year. So what that will mean is when we come to the end of the year, it will be the 900, the difference that goes off to the statement of profit and loss. I'll put it in here. As it's going into our irrecoverable debt, so we've done and dusted with that account. So now we can concentrate on the specific and general provision. The problem is that although we allow the specific first, specific and general are important from a tax point of view as well. If you do the personal tax unit, you'll learn that specific is allowable for tax purposes, the general isn't. So what we've actually got to do is allow for it first when we calculate the 5%. So what I'm going to need to do is to take our 51,000, that's the 52,000 minus the 1,000, take off the specific and then work out my 5%. There's no existing allowance for doubtful debts, so I can do it easily here. Oops, oh, actually I might as well have just done. Take off the specific and then calculate the general provision. Have I typed that right? 52,000 minus 1,000. Yep, times 5% to 550. Except it's not 52,000, it's 51,000. There we are, that's better. Because 52,000 minus 1,000, then minus the irrecoverable debt, then take off the specific. So that one will go into the allowance for doubtful debts adjustment account. So we're actually doing might see the words specific or general here in this case, or it might just be allowance for doubtful debts, and some people would put the two together. Why not? It shows the same thing. So we've actually calculated our general 5%, having taken into consideration the specific, and then we need to put in the specific as well. That's our specific coming in, and that means a total of 3,500. Yep. Of which 1,000 specific, 2,500 general. So if people combine them, that's fine, but I always find it confuses things, particularly at the start of the next year when you want to work out adjustments and whether it goes up. So the total amount going into the profit and loss is 4,400, and if you balance these ones off, so actually I better do that I suppose. So 3,500 adjustment, 900 from the irrecoverable debts, and carry down 3,500. I suppose it'd be number 6. And that means in our statement of profit and loss, sales at a control account of 51,000 minus our allowance for doubtful debts, giving us 47,500 receivables. So one last thing to do. Let's just have a look at what if we combine the irrecoverable debts and the adjustment account, well, we can do a quick copy. That will need copying as it is. And then add 2 adjustments. Oops, didn't need to do that. I went to do that. So the figure that will go into our statement of profit and loss as an irrecoverable debts item will be a debit, an expense of 4,400. And that's most of what happens with irrecoverable debts. The only other questions might be the journal. So think about the T account. That one is credit the allowance for doubtful debts and debit irrecoverable debts.